So what did the Fed minutes tell us about the behind the closed door conversations at last month's meeting? Hi, I'm Jeffrey Roach, Chief Economist for LPL Financial. In this Econ Market Minute, I will give you 3 highlights of the past week and 3 potential market movers for the week ahead. So let's start with 3 highlights from this past week. First, the U.S. economy added 372,000 jobs in June, at just a slightly lower clip from May, while the unemployment rate remained unchanged. The participation rate dipped to 62.2% in June. In contrast to what some pundits are suggesting, the economy is not currently in recession. We should expect the labor market to expand, but at a slower pace, as firms still struggle with finding suitable workers. Firms will still likely be increasing wages as they deal with a shortage of qualified workers and elevated quit rates. The high number of people not returning to the workforce is one of the nagging problems with the labor market right now. Relative to pre-pandemic levels, the economy has 4.8 million people more out of the labor force. Some likely took early retirements, but that does not explain the rest of the story. The labor market will remain tight with low unemployment, as roughly 5 million people have not yet rejoined the workforce. Second, the Fed minutes this past week revealed that members of the FOMC are giving themselves some leeway, stating that, quote, 50 or 75 basis points, unquote, are appropriate at the July meeting. So a prolonged cadence of 75 basis point hikes is not likely in the cards, especially as the economy weakens. Given the slowdown in the economic activity, I think markets will begin to reprice Fed fund expectations for both this year and next year. Supply bottlenecks are integral for policymaker forecasts. Investors should track shipping data as a leading indicator for eventual supply chain improvements. Job openings continue to outpace individuals looking for work, and Chair Powell specifically said that the Fed's commitment to lowering inflation could come at the expense of the low unemployment rate. So third highlight from the last week, New York Fed Reserve supply chain pressure gauge. The global supply chains were under less pressure in June relative to May. Bottlenecks improved in June as Chinese supply delivery times improved throughout the month. The small improvement in supply chains will eventually filter through to improved consumer pricing. On average, effects from supply chains take roughly 4 months to filter through to headline consumer prices. So as supply chains and logistics improve, we should see some easing in inflationary pressures in the coming months. So how about 3 potential market movers as we preview the week ahead? First, June CPI figures will be released at the middle of the week. Most important for investors is, remember, the CPI is a measure of the average change over time in prices paid by urban consumers for this representative basket of goods and services. This metric is not the preferred metric for central bankers because it does not incorporate product substitution as those relative prices change. So this metric is still extremely important to track as it's used to adjust federally mandated cost of living adjustments. How about private sector wage and salaries? Residential rent prices. So whether we like it or not, this CPI directly affects hundreds of millions of Americans. Second, the market will get a read on retail sales for June. Especially relevant this month is what we call the control group within the retail sales report. This portion of the retail sales report goes into the GDP calculations for consumption. And then those items such as building materials and others go into the calculations for business investment. Since the retail sales data covers the month of June, we can now get a better look at overall economic growth in the second quarter of this year. Third major item to discuss is industrial production. Why, you might ask? Well, this measure is important for combating the recession talk that we hear. We are not in a recession because of this metric right here, industrial production. That's in part. Manufacturing activity is fairly solid, as manufacturing for motor vehicles and related parts are playing catch up from last year. Mining activity has also been strong so far this year, and looking at industrial production in tandem with the latest job market figures, I find it very difficult to anticipate the National Bureau of Economic Research to announce that the US is in a recession. I had one point of caution. The risk of inflation staying higher for longer does increase recession risks for the next year. See you next time for more economic insights for your week, and be sure to follow me and the rest of the LPL research team on social media for more global market updates.